Good morning, everybody. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we're here to talk about CPI today, which is coming down the pike. The number is going to come out from the Bureau of Labor Statistics in just about 5 minutes, maybe 4. The expectation for today is that your core consumer price index, that's excluding volatile food and energy, will have increased 0.3% from the previous month. And that would leave your core number at a 3 point. Just dig in here. It looks like 3.6%. And so the deal here is that we are coming off of a rough patch. We had solid disinflation in the back end of 2023. The Federal Reserve was very encouraged by what they saw. And then 2024 rolls around, and it's been a really rough start to the year. 3 straight reports in which inflation was simply too high to be palatable for Federal Reserve policymakers, and 3 straight reports in which the number exceeded expectations. And so we're looking to see if this can mellow out a little bit here. We're looking to see if inflation will become a little bit more predictable here. So, Allison, why in your mind did the disinflation process seem to stall in the first quarter?
Well, I mean, we did, inflation, I think initially had a lot of fathers, and some of it was, the supply chain issues, and that made goods price inflation go up a lot. And, we worked that out, and the, pandemic economy went away. And so we had a lot of goods price disinflation, and that took us, most of the way there. But in the meantime, as we know about inflation, it can sort of start to seep into expectations, even if it wasn't in a lot of financial indicators. And eventually, wages started to go up. I don't know if I'm calling this because price inflation, a wage price spiral quite yet, but we do still have higher wages. And, now that's sort of more in the service economy, and it's just inflation is sort of stickier there. So, I said, I mean, we got the easy part done. And as I said, now we have sort of inflation that tends to be a little bit more persistent.
Okay, so service economy. Speaking of which, we have our insurance guy here with us today, Matthew Palasola. Matt is our senior analyst with Bloomberg Intelligence covering insurance. And he's going to help us understand why motor vehicle insurance has been such a problem category in this index. Just to give you an idea, like last month, about a quarter of core inflation was motor vehicle insurance, right? So these numbers are moving around a lot, and it's doing a lot for our impression of what's going on with the price level in general. So Matt, what is going on here?
So John, what happened was, we like to look at maybe pre-COVID and, the COVID effect and now after, right? And what happened during COVID? A lot of people stopped driving. When a lot of people stopped driving, auto insurance companies actually started giving back money. They started giving back refunds. They probably would have been forced to do that anyway, but they tried to get ahead of regulators and do it. Some of them actually then lowered prices to try to gain share. What they didn't expect to happen were these supply chain issues. So the cost of auto parts, the cost of cars themselves, which were replacement costs, all spiked. And they were kind of caught flat-footed when this happened. Not only that, but then accidents came back. Car accidents came back, people started driving again. These companies started losing a lot of money, and they had to play catch-up. They started to try to raise prices. They raised prices across the country, but in a lot of the biggest states in the country, the regulators pushed back on those rate increases. So auto insurance companies, they target about a 4% underwriting profit on premiums, right? And what was happening was they were losing up to 15% on that. State Farm in 2023 lost $10 billion on auto insurance. So they've been losing copious amounts of money in this business, and they've been trying to play catch up. right now we're starting to see results get a little bit better, but I don't think
I'm
prices
going to
are
cut
going to
you off when
increase.
the number hits.
Okay,
Okay,
sure.
I'm sorry to cut you off. Okay, so CPI month on month comes in at 0.3% versus the expectation of 0.4%, a little bit below on the headline. CPI core month on month, seasonally adjusted, comes in at 0.3%. Again, in line with the expectation. And then on a year-on-year basis, that translates into 3.4% on the headline, 3.6% on the core. Both of those numbers are spot on. You know, I like predictability. That feels pretty good compared to what we were getting, which was 3 straight misses to start the year. Allison, I don't know what you think about why we've been missing so many of these numbers, but you gotta like predictability. Am I right?
Yeah, I feel like we spent a year being shocked at how high the numbers were, then we were shocked at how low they were, and now is it like, I mean, I said, like, I think we might just be equilibrating to, this is where just inflation is. Like, I think everyone's sort of assuming that naturally we should be at 2 and keep expecting to fall, but maybe this is just, sort of, I guess, like we would say, a natural rate of inflation, and despite the Fed's best efforts.
Okay, so Matt, I cut you off. I cut you off midstream here, but I want to hear more about where insurance is and also where it's going. And while you're doing that, I'm going to dig in here and see exactly what happened on these critical components this month and put it up on the screen for folks. But so. First of all, please finish your story about how we got here on insurance, and if you could, I would love if you would put it into context of where is that going.
Sure. So I didn't see the numbers yet, but I wouldn't be surprised if they were similar to last month. I think where we're going, there's going to be 2 major factors, right? The big public players, Allstate, Progressive, Geico, which is part of Berkshire Hathaway, their results are getting better. Their underwriting results. So they're losing. They're actually not even losing money on auto anymore. They were losing it. Now they're not. Right. They haven't really hit the growth button yet. What they will do is all these companies have cut a lot of advertising. I think that's going to be the first lever that they're going to pull. So I don't think you're going to see the price to consumers go down until probably later in the year. I think you're going to see more Gecko and Flow, on TV. But I think once they start pulling that later in the year, you're probably going to see them compete on price. Auto insurance companies love to compete away excess profits. So I think when the problem was there were not excess profits, there were no profits, right? So I think what's going to happen when they start to get into that position again is they're going to compete. The other factor, though, is State Farm, which is a mutual insurance company. So they're not public. They're basically owned by their policyholders. They really haven't been raising prices as much, and they've been gaining share. And as a result, the results have been pretty bad. So I think they are, on the other hand, going to have to start raising prices. So that may actually keep prices up since they're so big, but then you're going to see a lot of these other companies who are big in their own right and some of the smaller ones probably lower prices to compete and steal some business from State Farm.
Okay. So I'm actually I'm running a little bit behind on my graphics here, but I did want to I did want to address one other point about the market reaction here, and let me put this up on the screen for everybody. But so this right here is a lot of fun. So we get whoops, sorry about that. Let me fix that as well. I'm blowing it on the graphics today, but so here's the point. Here's the headline on an inline number, Allison. We have the yield on the 10-year Treasury note down about 8 basis points.
Mm-hmm.
Whoo! What's going on there?
On the 10-year?
Yes, exactly. So we have the story here is that the confluence of bad news, I think you could say, in the first quarter, which was, this sort of sense that the fiscal deficit is a problem that's not going away. This sense that geopolitical problems remain an economic issue, oil spiking, and then the 3 consecutive bad inflation reports took us up again. Darn close to 5% yields on the 10-year again. Call it 475, right? And since we peaked up there, since we hit a local peak, in the 470s several weeks ago, this 10-year yield is coming back down a lot, and we now see it sitting at 4.36%. But I'm interested in what drives. Okay, so it's the market reaction is getting slightly more muted as I speak. But my point is, like, what kind of market psychology drives a 7, 8, 9 basis point move on the 10-year off of an inline number? How do you interpret that?
I would expect that because, okay, if you look at what's in the term premium, it's inflation risk and which includes inflation uncertainty. So the fact that the number is online suggests less uncertainty would be fed into the term premium.
Okay. All right. Fair enough. All right. I'm still struggling with a little bit of graphics issues here. But so let me turn back to you, Matt. I'm still, worried about risks of this insurance situation delivering more surprises coming down the line. And what I've noticed is that you sort of have to, mark your calendar for these key events. Such and such a company has a request in before the state of California, and if it gets approved, then it's going to go into the numbers in X month. Are there any key dates that you're watching that you think could determine the trajectory of premiums, sort of in the near to medium term here?
Yeah, it's hard on specific dates. You can look and see some states like California. They do have public rate filings where you can look and see, and I believe that comes out maybe once a week or once every other week, and you can see the companies that have filed for rate increases and if they may continue to come down. We just had this morning, actually, Progressive reports monthly earnings, and that's kind of a indicator of their profitability and how they might act going forward. The other companies will all do it on a quarterly basis. It looked like Progressive's numbers were pretty good for April, so their underwriting margin was quite good. I think still on this lower advertising. So I think you're still going to see these numbers. I'm surprised. So I do see the number was like 22% again, and I think getting into the teens is probably going to happen sooner rather than later. But State Farm remains that wild card on where they're going to be raising prices across the country. But I can't imagine for consumers this kind of lasts. And what's really not reflected in these numbers is home insurance as well. I think the home insurance is measured in a different way, and it's just not as reflective of what's going on in the market. So there's this kind of phantom thing in there where home insurance rates are going up a lot, and it's not really reflected in these numbers. I think the trends for insurers there are actually a lot worse, and I think that's going to continue to happen, but may not be reflected in these numbers.
That's not good.
No, not good. Not good, especially if you live in Florida, California, or any kind of coastal areas. Not only are the prices going up, but you may even have difficulty even getting insurance.
Yeah, and I feel like this feeds the people really angry about inflation and everyone being like, "What's wrong? The data looks great."
Yeah, no, I mean, the inflation in these things that go into the insurance loss costs have been a lot higher, on a go-forward basis. Even the pieces that go into auto repair was almost 10%, hospital services 7.7%. So those things are still far above the kind of headline inflation rate.
Yeah, it is one of those things that I think is really tangible and painful for people, and there is some debate over how best to measure inflation in something like insurance, because you say, well, the premium's going up, but it's insuring a more valuable underlying thing. So if I'm getting a bigger service or whatever for it, is that really inflation? And so in other competing indices, they will actually measure it on sort of a net basis, and you'll come to a different conclusion. But I think from a psychological standpoint, 100% in agreement. Like, people see an auto insurance premium, or God forbid, a home insurance premium go up like 35%, 40%, like that is gonna leave an impression. And no matter how your government statistics agency decides to define it, you're going to say, wow, I'm experiencing a lot of inflation.
And you're
Go ahead.
seeing the government response to a lot of this stuff in the States. On the auto side, they're going to lose. The auto insurers are going to lose the justification for raising prices so much. The home insurance companies, which tend to be the same companies, but those lines of business, they are still losing money, kind of hand over fist.
Okay. All right. I did. I apologize for my technical difficulties here, but I did put a little bit of a sector by sector breakdown up on the screen that folks can hopefully see. But a couple things that I wanted to underscore here about what's going on here. So you see new vehicle prices stepping down meaningfully on a month-on-month basis. You also see used cars and trucks stepping down on a month-on-month basis. We've been talking a lot about insurance here, but this is one of these things where, if you believe that disinflation, or even as we're seeing on our screen now, outright deflation in these goods categories could continue, maybe that's your disinflation, a little bit of your disinflation in your auto insurance a few years down the line, if all else equal, let's say. So I find this interesting. Apparel, again, seasonally adjusted month on month. Apparel has stayed kind of warm, a meaningful contributor. It's not like a gigantic category like an autos, and so it can't single-handedly move around the inflation data. But I always do wonder, like, what it's telling me about the American consumer. I will say that as we've seen some warmth in the apparel numbers in previous months, it's oftentimes been footwear. I think that there may be some component to shipping costs, where we saw some disruption in the cost of container shipping earlier in the year due to conflict in the Red Sea and so forth. Moving down the line here, you see that all-in shelter number, which includes your rent of primary residence and your owner's equivalent rent. You see that sort of moving sideways on a month-on-month basis. Your transportation services is sort of the umbrella category that includes your auto insurance. Lately, the auto insurance has been the biggest thing moving that around. So while Matthew highlighted, the year-on-year number still looks pretty eye-popping. At 11%, 12 month for the transportation services. You do see this stepping down on a sequential basis, from a 1.5 to a 0.9. So you have to sort of like that. Allison, you wrote recently that longer term market interest rates may stay higher for the foreseeable future, irrespective of sort of the way the ping pong ball bounces on these month to month numbers and what the Fed ultimately does with interest rates. And your point is, one of your points, I'll let you explain yourself in your own terms, but one of your points is like, the Fed can do what the Fed's going to do, but the market is going to set the long-term interest rate. The market's going to set the 10-year yield. The 10-year yield is going to determine where your mortgage rate is at, and so forth. So why do you think that?
Well, again, let's think about the term premium. A big part of it is, as I said, inflation, both expected inflation and inflation risk. And, as you see, I'm of the school that inflation just might be higher going forward, and higher inflation tends to be more variable and uncertain inflation. So that right there is going to increase the term premium. And just bigger sort of macro trends that we have, an aging population we have to pay for. A lot of infrastructure plans we've got in the works that are only going to get bigger. So there's just a lot of debt we're planning on issuing, much bigger than before. But at the same time, it's not clear that the buyers are going to be as enthusiastic as they were in the past. I think people got very attached to the idea in the 2010s that we'd enter this new regime of zero real rates, even on the 10-year. And you do get these 10-year or 15-year sort of experiences with one interest rate, but they do kind of trend up generally. I'm still like one of the last holdouts who believes in some mean reversion in bond rates. So also, I mean, it's been less true lately, maybe because of QE, but generally the data shows that the 5-year and beyond is segmented from the shorter term interest rates, where the monetary policy has a lot of control. So generally it is more market forces. The market forces just don't seem, I mean, maybe interest rates will go down for a while, but I think like at least in the medium term, we'll be looking at longer tenure.
Okay, but the thing is, I mean, U.S. Treasury sells the safe asset that the world wants. This is, this is global collateral, and when folks suggest that, on balance, maybe the demand for the world's safe asset may decline, I mean, like what's going to replace it? People still need the safest place that you can park your money, right?
Well, if we have a higher inflation, more variable environment, it's not as safe. It's never been like we've had this one like ultimate safe asset, and this just happens to be U.S. bonds. We always had the safer asset. So, and I think there's also reason to worry that like a lot of the big buyers of the last couple decades, just had a lot of money they wanted to park, partially for their own currency reasons, and they're just going to have less cash to spend, less like money to park somewhere. So it's not like they're going to be like, "Ooh, the U.S. is risky now, and I'm going to stay away from this." They just sort of said we'll have other needs. Also, I mean, part of the demand to put your money in the safe assets was, in a bigger global trading environment. It's largely how you control your currency, and you're doing a lot of business in the U.S. So you do want to have more money in U.S. assets, and that could also change.
Okay, all right. Let's do decomposition, because yours truly finally got his act together here. So what do we have here? What's going on in this inline figure? First thing I want to underscore, always kind of the same story. It's core services, right? Core goods are not causing the problem. At the margin, you could argue that some things are not deflating precisely as some goods are not deflating precisely as they were pre-pandemic, but it is by and large a core services issue. So as we dig into to core services here, again, a story that you've heard us tell on this live stream before is that within that, it is still largely shelter, right? So where we're talking about core services, a full half of the contribution from core services is coming from shelter. And sequentially, if you just look at where we've come from on shelter, it is stepping down, but it's not it's not taking big steps down, right? So January was the really hot one in terms of the contribution. Again, this is not the month-on-month number. This is the contribution to overall core services. So shelter was huge in January. It steps down in an important way, or sort of normalizes, you might say, in February. And since then, February, March, April, it's been stepping down a little bit, but it's like a basis point here, a basis point there. It's not the kind of improvement where you're going to say, we're almost at target. No, this is a a very sluggish category, and it's going to continue to be sluggish. I'm looking around for any other potential surprises here, and I don't really see them. So again, transportation services, we've been talking a lot about that. So let me just go in here. Okay, so what you see is motor vehicle insurance. The contribution has been stepping down. It contributed 12 bips to this overall core services number last month, and it only contributes 8 bips here. So that is improvement. I think, if we were doing a side by side of what was normal for this category, that would still register as much too high compared to what we were used to in like a 2017 to a 2019. But it is stepping down, and it's moving in sort of the right direction. Let's see. There were a couple of other interesting things. I'm always curious what's going on with financial services here in the other personal services category, because this is an April number, so we do get the sort of once a year inflation that we experience in tax preparation. So I don't have that degree of granularity here just yet, but that could be a thesis for why you see some warmth in financial services. Glad to see that the March shock in funeral inflation is it seems to be behind us. But all told, like you look at the decomposition of this, it feels like we're not getting new surprises, Allison. I personally like that a lot, like digging under the hood, because there's room for disagreement here, but I personally am not terribly concerned with the high numbers that we've been seeing in shelter, because I do believe there's still reason to believe in the forecast that it's coming down. Matt's eloquently laid out why there's still risk here in insurance, but it seems like the kind of heat that we have seen in insurance over the past 12 months is probably not likely to linger. So when I look at this decomposition and I see biggest areas of concern by a ways are still basically like shelter and insurance, and there's not a lot of new surprises coming in there, I feel pretty good about that. What do you think, Alice?
Yeah, I feel good too. I mean, I don't know if we can see any real source that's going to bring us back to 2, but definitely.
Well, the shelter disinflation, right? I mean, come on, if my story pans out, we're golden.
I don't know about that, but I think the housing market is still it's weird because of mortgage rates being what they are and people being used to something much lower. So it might go down, but I'm not sure. I mean, I said I feel like we're kind of equilibrating at this level, and that's one of the reasons we're not seeing surprises. And you know what? It's not a bad level. I mean, historically, this isn't bad. So, I mean, the economy's strong, inflation's, higher than we'd like, but not terrible. I mean, I think I feel like we keep seeing these reports and there's not a lot to feel bad about.
Yeah, well, I don't feel too bad. I don't feel too bad about this one either. I think we can end it right there. The yield on your 10-year Treasury note is about 4.35%. So the fixed income market holding on to those gains on the back of this inline report, but to my mind, comforting report, because we're not seeing new negative surprises. I want to say thank you to Allison Schrager. She's the author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk, and a senior fellow at the Manhattan Institute. Thank you to Matt Palazzola, senior analyst with Bloomberg Intelligence covering insurance. And thank you to everybody for tuning in.